It's a turning pitch and we will play our shots very carefully. Certain components of personal loans are, however, recording very high growth. These are being closely monitored by the Reserve Bank for any signs of incipient stress. Banks and NBFCs would be well advised to strengthen their internal surveillance mechanisms, address the buildup of risks, if any, and institute suitable safeguards in their own interest. The need of the hour is robust risk management and stronger underwriting standards. The global financial landscape is rapidly changing and potential stress may emerge from unanticipated corners. The Reserve Bank is closely monitoring the evolving situation and will act proactively to maintain financial stability.
That was Reserve Bank of India Governor Shaktikanta Das padding up for a long innings against the enemy number one, inflation. Though the central bank has decided against hiking interest rates for the fourth time in a row, it has retained its hawkish stance. The biggest concern, the Reserve Bank of India says, is the risk of food and fuel prices rising again, especially with an uneven monsoon. So it is clear that the inflation spiral remains the RBI's top concern. Hello and welcome to Easynomics. I'm Siddharth Zarabi, and with me today to discuss the import of what the MPC has done today is Abheek Barua, the Chief Economist of HDFC Bank, and Decode Joshi, the Chief Economist of CRISIL. Coming to you, Abheek, first. Analogy of cricket being used to describe what the RBI is trying to do, and clearly a turning pitch, and the governor saying that they will play their shots carefully. In your assessment, how did the MPC and the RBI come out and bat today?
Well, I think the metaphor was appropriate. I think at this stage, you don't need to, hit a sixer. You just need to play cleanly on the front foot and just indicate to your opponents, I'm sorry, I'm stretching the metaphor, but indicate to your opponents that you're ready to sort of hit anything that sort of comes your way, which is unexpected. So apart from inflation risks, I think there was a lot of emphasis on financial stability as one of the sort of the googlies that could come the RBI's way. And the RBI is saying that, look, we are, well padded up. We have our instruments in place, and we will, address both the issue of inflation were it to spike up again, and financial stability risks. There was a lot of discussion on this in the press conference coming from the global markets. So I think it did rather well. But I think, to go back to the cricket metaphor, this is turning out to be a long, good old-fashioned test match, the slog against inflation, rather than a sort of a T20 or an ODI. So we'll have to be patient.
Well, patience is key, especially when we consider test cricket. Mr. Joshi, we'll take that forward. And the googly that Abheek referred to, according to you, is the googly really the one that's likely to come from overseas? We've seen what's been happening to bond yields. We are also seeing what's happening to crude oil prices. And I say this in the context of domestic inflation now perhaps not as major a concern as it was 2 or 3 months ago.
Well, I think the first googly came from vegetables, the tomato, I think, which spiked the overall inflation to 7.4% in July. That's how the quarter started. And then I think the vegetable prices are volatile. We know they're correct also because crops have a very short cycle, and vegetable prices have already come down. Actually, tomato prices have been crushed to a great extent. So that fear was gone. And then suddenly the oil prices started rising. and which have been extremely volatile. So the central bank, and not because the global growth is very strong, I think it's largely because of the geopolitics and supply cuts, etc. So that will remain a risk even if the global economy slows down. I think the risk of oil always remains with us. And on top of that, I think the hawkish stance from the Fed, and even I think the ECB is going to continue with its rate hike. I think that's our house view. So I think all that raised the yields to a level I think not seen in last 16 years. And as a result, I think there was a capital outflow, and the dollar was strengthening because capital was going towards the US, and as a consequence, I think the rupee was also weakening. So RBI had to also an additional battle of streamlining movements in the rupee. So I think these are all the known factors, I think. But there could be other googlies also, which we really don't know of. So I think, as I said earlier, even the vegetable inflation spike was not anticipated at all. I think it just happened suddenly.
Well, the RBI clearly batted up and ready at the strikers' end, and on the non-strikers' end, it's the government also which has been doing some things as far as the supply side is concerned. Abheek, some of the red flags that have been mentioned, and I just want to quickly recount them and then ask you to deconstruct that for our audience. And viewers, I just need to take a pause here. I was earlier today informed by my producer Sujit that this show is being used by some candidates who are preparing for competitive exams. So Abheek, that's the backdrop. People really like to understand difficult macroeconomics in an easy way. That's why the name also Easynomics. The 5 red flags. Transmission of the 250 basis points rate hike is incomplete still. The global economy is slowing due to interest rate hikes. Trade is contracting, and India's exports have also fallen as a consequence, and FDI inflows have also receded in the April to July period, down almost 64%. This seems to be the broader macroeconomic reading of the RBI. Abheek, deconstruct this for our viewers.
One of the things that central banks talk about and economists talk about, that the impact of an interest rate hike is often not immediate. You see some immediate effects on things like home loan rates or car loan rates, but then you have sort of a slow cascading effect which works through the system over a prolonged period of time. Unfortunately, there is no hard evidence on how long the lags could be. So, one of the ways of doing this is by looking at, say, the increase in loan rates. So, what has happened is while deposit rates have moved up, loan rates across the system, apart from some of these categories that I talked about, have not moved up that much. So there is still some amount of what we call transmission, or the impact of the policy rate hike, which is the repo rate hike, onto actual lending and borrowing rates. So I think this is something that people need to keep in mind when assessing monetary policy. It might seem a bit of gobbledygook, but we know that this is how monetary policy works, and you have to sort of give it time to work its way through the system. So that's something that he flagged, that look, I mean, it's still not, we might be done and dusted, or at least temporarily done and dusted with the policy rate hike. But hang on, I mean, there is more to come in terms of the actual impact on inflation and through the impact of the economy. Then, of course, let me take up the issue of export contraction. The global economy is slowing down. The US is slowing down, albeit not at the pace that people had expected earlier. Europe is slowing down. On top of that, you have sort of political tensions and so forth, some degree of protection, of reshoring back to the to home economies, so that sort of good old fashioned days of extreme globalization, when one part of a cell phone was produced in Brazil, the other was produced somewhere else, that is going away. So both due to the sort of deceleration in the global economy, as well as these sort of what we call structural changes that are taking place, driven partly by politics, you are beginning to see trade contract, which is not a particularly desirable outcome. So I've covered two. Should I
Now,
ask my good?
no, it's let me go on the other couple of points to DK Joshi. The some of the points that Abheek spoke about in terms of the red flags. Do you want to expand on that?
Well, I think I will just add a little bit to on the export side, where we did some work. I think what's happening is in the global economy, the faster growing part of the world is Asia Pacific. And actually, India's exports to Asia Pacific have slowed down pretty sharply, much sharply than they have slowed down to the western part of the world. So now, just to give you an example, our exports to APAC region were about little over 33% in FY19. Today, they are around 26%. So we have increased our exposure to countries like US and Europe. Europe is already slowing down, and S&P expects 0.6% growth this year. US has held up because I think the fiscal policy there is very loose. So some of the what the rate hikes were supposed to do was getting offset by the loose fiscal policy. So clearly, I think now going ahead, so headwinds to trade, particularly merchandise trade, I think will increase, because I think the countries to which we had increased our exposure are more vulnerable at this juncture. So that is on the export side, and rest, I think, on the monetary policy. Yes, I think I agree with how Abheek had put it very nicely. I think the lags are still playing out, and I think the central bank has given a signal that it wants the transmission to be complete, which essentially means that they'll be withdrawing accommodation continuously, which points a little towards the tighter side of liquidity. I mean, so that's how I would read it.
Okay, Abheek, it's not all gloom and doom. Because there are some silver linings, and the 7 silver linings, viewers, that we have culled out, we are playing them out on the screen. Number 1, continued resilience in economic activity in the country, sustained momentum in the agriculture sector, extended recovery in the industrial sector, good construction and manufacturing activity, strong investments, particularly the government capex push, and we all know that the government could also be the chief builder really in some ways. Healthy rise in capacity utilization, so everybody is working to produce more and more, and signs of revival in rural demand. Abheek, how significant is this revival in rural demand, just to pick up one of those silver linings that were mentioned?
Right. I think for a while, I think for most of last year and the earlier part of this year, rural demand seemed subdued. It could have been due to a number of factors. I think the second wave of COVID really hit the rural sector very hard. And you must recognize that the rural sector is not just agriculture. It has a lot of micro and small enterprises there, which were particularly affected by COVID, since household balance sheets. So the owner of a small company, he had to spend a lot on his medical expenses. So that left him with very little to actually sort of keep the business running. So there were huge problems, and I'm not going to go into all the details. But suffice to say that the rural economy wasn't doing well. I think from the second quarter of this year, we've seen a pickup in rural expenditures. And if you talk to the FMCG companies, they will tell you how that's manifesting. They are able to take price increases. some of the small companies that have completely gone out of business have all started coming back in. So that is that's a good thing, because I mean the rural sector in terms of population has a much bigger share in the economy. The only risk, I think, despite the silver lining, is that agriculture has been a little iffy, particularly in terms of certain crops, pulses, spices. He pointed out, and cereals in some cases. And there could be two effects. One is inflation, which eats into disposable incomes because of a rise in these prices. Number two, if you are not, producing, if the rains haven't been adequate, you haven't been able to produce that amount, then your incomes might get hit. So I would think that yes, it's something to cheer, but I mean, let's not forget some of the risks which are still there in the rural economy.
DK Joshi, in terms of the construction and manufacturing numbers and strong investments driven by government capex, how significant is this?
Well, it's quite significant. But if you look at the GDP data that has been released for the most recently, I think investment is the key driver. Investment to GDP ratio has been rising over time, and the major driver of that has, of course, been government. The private sector is in a position to invest. I think their balance sheets are healthy. The capacity utilization does support investments. And also, I think the PLI scheme has succeeded in front-loading investments in some segment. So I think, but they haven't finally picked up the baton from the government. See, government can't keep investing because it has to also focus on fiscal consolidation. The kind of investments we have seen in this year, I think may not be continued going ahead. So they'll have to pace it down. Now, private sector has to take the baton from them, and they are in a position to do that. And I think because of the environment, I think, which is a little uncertain, so the broad basing of private investment is a gradual process. I think investments have played a very, very important role in this recovery post-pandemic.
Abheek, before we go to some of the other aspects, especially comments about personal loans, I want you to tell our viewers, in terms of the current overall political economy imperatives. We'll soon have elections being announced in 3 states, and then the big one next year, the national election. From today's policy, what do you think the consequent impact will be in terms of the government response? Because control of inflation will become primary from a political point of view, yet the government would not want growth to dip because that will impact overall sentiment.
Yes, but I think you are not. Well, you sort of left out the elephant in the room, which is sort of the fiscal bit. So you can have a completely, the central bank and the government pulling in different directions. The government sort of spending away and expecting the central bank to do the heavy lifting in terms of bringing down inflation. I think despite all the capex, the infrastructure spending and so forth, I think this government is fundamentally very committed to fiscal consolidation. This is perhaps not true of some of the states that are going into state elections, but they have sort of external caps placed on them in terms of how much they can borrow and spend. So I think this is it's commendable that it is this management of the growth inflation dynamic and trade-off is being done in a sort of coordinated fashion. And if you just think back 10 years ago, etc., there was a lot of tension between the central bank and the government, if you like, in terms of what the government was doing and what the central bank would have liked the government to do. But this time, I think they are kind of on the same page, singing from the same hymn sheet. So it's far more easier, I think, now to both retain the growth momentum to a degree, and also control inflation.
Mr. Joshi, do you think that this is one of the biggest risks, internal risks, as we look at populism and the need to continue to give subsidies, especially, for example, on the oil account? We've already had some announcements with Ujjwala, and we are seeing pump prices have remained frozen for many, many months now.
Well, I think the fiscal profligacy is always a risk, but as Abheek was pointing out, the government actually has been very prudent. I would say they are fiscally conservative, so they would not let the deficit go out of hand. I think that's number one. And it's possible, I think, that some of the infrastructure investments that government had planned, some of that might get shifted towards consumption spending if inflation remains high and if, I think, some subsidies are provided. But that's not going to mess up the fiscal math at the central government level. Now, states are a different animal. I think some states are in good health, fiscal health, others are not. So I think the competitive populism there, I think, is a risk to some of the states, I think, which are particularly fiscally vulnerable, which have high debt to GDP ratio. So I would say that it's not that much. It's not a problem at the central level. It's more of a problem at the subnational level, at some of the states level.
Absolutely, and we didn't discuss the issues that are coming up on pension. We leave that for some other time. Abheek, and now what the governor said on personal loans. Let's bring up some of those key pointers. Some parts of personal loans growing very sharply. This was the governor's comment. Banks and NBFCs well advised to strengthen surveillance. RBI closely monitoring personal loan growth, the sharp growth, and the advice to improve risk management and underwriting. Abheek, what is being said here? What is the governor really speaking about?
If one category of loans, particularly in this case retail loans, show a remarkable increase, there are some components of retail loans that are not backed by collateral, or I think the Hindi word is girvi. So you can't sort of keep the collateral and sell it off and redeem whatever money you have given to the borrower. So this is, for instance, unsecured personal loans, credit card loans, etc. So I think it's natural that when you see some kind of a very, very sharp increase, that there is a possibility that the banks might be getting into a territory since loan growth has already been so high, you are getting into a territory where you are lending to not such sort of creditworthy borrowers. So I don't think it's a crisis yet, but I think the RBI made and the governor made it very clear that this is a risk that remains, particularly on unsecured loans, simply because loan growth has been so high. Initially, you lend to the most creditworthy individuals, and then as you start to expand your credit portfolio, you might tend to, and in certain cases, lend without collateral to categories of households that might not pay back your loan, to put it very simply. And we need to watch out for it. I don't think it's a big systemic issue now, but I think going forward, if banks are not careful, and that hence the exhortation today, then there could be a bit of a problem there.
Not a systemic issue. DK Joshi, explain to our viewers why are India bond yields jumping?
I think a couple of reasons. I think one is the liquidity. I think if you notice the behavior of bonds, I think since 2022, I think even before RBI started raising rates, I think they were tightening liquidity, and that was immediately showing up in the bond yield. So I think the tightening liquidity has something to do with it. I think the today I think they jumped quite a lot. I think this is most people are linking it to the OMO announcement. My sense is that they will not remain at these levels. They'll come off these levels, and I think we have a projection of around 7.20, 7.25. That is the range we see. I think today they jumped rather too sharply. I think it's in the short run, it has to do with the liquidity. And then I think the other reason why bonds typically tend to go up is the oil prices. When the crude prices start moving up, I think immediately we see its reflection on bond yields. I think, and what happened today was a little different because crude prices have been dropping globally. Brent is actually below 85 now, and yet I think the yields are rising. So there are different sets of factors that come into play. Right now, I think it's the liquidity that is influencing the most.
Abheek, do you expect this jumpiness to kind of settle down in the near future?
No, unfortunately, I think the global situation is very murky. And just to add to what DK was saying, that there is also an impact on local bond yields from US bond yields, which have sort of risen to sort of semi-record highs.
Yes.
And that is because the US central bank is keeping the markets guessing in the middle of a situation where yields are rising very rapidly. I don't think this is going to go away very soon. And this has, I'm not going to go into the sort of detail of it, this has an impact on, capital inflows and outflows into India, and on Indian bonds, not, one-to-one, but certainly some impact. So I think as long as this global situation remains uncertain, and I don't see this going away in a hurry, and of course, apart from that, you have the uncertainty about where oil prices are headed, and so forth. I don't think we can sort of heave a sigh of relief soon. To go back to the initial metaphor that I tried to use, I mean, this is going to be, really sort of hard slog test cricket, which we have to play over the next few months with, no guarantees of victory.
Absolutely. And viewers, I'm going to end the show by adding one comment that Nilesh Shah put out, and he said the RBI governor mentioned that the pitch is turning and we will play the ball on merit. He described today's policy like the Kapil Dev policy, saying that the RBI will manage liquidity, inflation, growth, rupee and financial sector stability in an appropriate equilibrium like a legendary all-rounder Kapil Dev, who managed bowling, batting, fielding and captainship. The RBI has worked hard to create a balance between growth and inflation, setting an example for the rest of the world. This policy continues to take that hard work forward. So that was one more view, viewers, but you heard Abheek Barua and DK Joshi explain the significance of a policy where on the face of it not much was done. The repo rate remains at what level it has been for quite some time now, but there's much more that the RBI is hinting towards in the future. Abheek Barua, DK Joshi, thank you very much for your time with us today. With that, it's a wrap on this episode of Easynomics. We'll be back with more. Until then, stay tuned in. Goodbye.